As of 12 p.m. Eastern Time, Pfizer Inc. is trading at $24.51 per share, down about 0.57% for the day. But let's be perfectly clear, this slight intraday dip is just noise. The real story, the one that has investors completely divided, is that this titan of the pharmaceutical industry, a company that literally helped the world reopen, is trading near a 52-week low and at levels it hasn't consistently seen in over a decade. The expectation for a stock like Pfizer is, or at least was, stability. You bought it for its fortress-like balance sheet, its global reach, and above all, its massive and reliable dividend. It was the quintessential widows and orphans stock, a core holding in any serious Fidelity wealth management account or Schwab Intelligent Portfolios allocation. The reality, as we're all seeing, is that Pfizer is now a show-me story, and the market is deeply skeptical. It is a company in the midst of a painful, protracted, and incredibly expensive transition, and investors are being forced to reevaluate what this company actually is. The conflict is obvious. The Pfizer that existed 3 years ago was a high-growth machine, posting record-breaking revenues from its COVID-19 vaccine, Comirnaty, and its antiviral treatment, Paxlovid. The expectation was that this windfall would be used to build a new, permanent, higher-growth platform for the company. The reality is that the COVID revenues have evaporated far faster than anyone, including Pfizer's own management, predicted. This has created a massive revenue cliff, a $17 billion patent cliff from 2025 to 2030 for legacy drugs like Eliquis and Ibrance, and a stock chart that looks like it's fallen off that cliff. The Pfizer stock price is reflecting a deep-seated fear that the company has no immediate way to replace that income. This isn't just a sentiment problem, it's an earnings problem. Analysts are expecting the company's third-quarter results, due tomorrow, to show a steep 36% decline in earnings per share year over year. That's the reality that is weighing on the stock, far more than any minor daily tick. So, how is Pfizer fighting back? This is where the bull versus bear debate gets really intense. First, management has initiated a massive cost realignment program. This is the corporate speak for a multi-billion-dollar cost-cutting and layoff initiative. They are on track to deliver $4.5 billion in net savings by the end of this year alone, with a total target of over $7.7 billion in savings by the end of 2027. This is an attempt to right-size the ship, to protect profit margins, and, most importantly, to protect the dividend. That dividend is the primary reason many investors are still holding on. At the current price, Pfizer is yielding a massive 7%. For context, that's a yield you'd expect from a struggling telecom, not a premier pharmaceutical giant. The high yield is itself a sign of the market's distress. It's a measure of how far the stock has fallen. The company recently declared its 348th consecutive quarterly dividend, 43 cents per share. While the payout ratio looked dangerously high based on last year's chaotic earnings, management's 2025 guidance for adjusted earnings per share between $2.80 and $3 would bring that payout ratio back down to a much more comfortable and sustainable 57%. Protecting this dividend is priority number one, because they know if they cut it, the last remaining investment thesis for many holders vanishes overnight. The second and far more important part of the new strategy is growth by acquisition. Pfizer took its COVID-era cash and made a colossal $43 billion bet acquiring Seagen, a leader in antibody-drug conjugates, or ADCs. This is the new core of the bull thesis. The expectation is that Seagen will make Pfizer an oncology powerhouse, a leader in targeted cancer therapies. This wasn't a small bolt-on, it was a fundamental shift in the company's focus. The Seagen portfolio, with drugs like Padcev, is already delivering double-digit growth. Pfizer projects that its oncology division, bolstered by Seagen, will have at least 8 blockbuster medicines by 2030. This is where the tension lies. The market sees the $43 billion price tag, looks at the debt Pfizer took on, and is telling the company, prove it. The integration of Seagen has to be flawless, and those new cancer drugs have to perform exceptionally well just to justify the premium paid, let alone actually grow the company. This is not a guaranteed win. It's a high-stakes bet that will take years to play out. And they aren't stopping there. The company is desperately trying to get into the hottest market in pharmaceuticals, the GLP-1 weight loss category. Knowing they were hopelessly behind Eli Lilly and Novo Nordisk, Pfizer recently acquired Metsera for $7.3 billion to get its hands on a promising pipeline of obesity candidates. This is another clear signal that the company is willing to spend billions to buy its way back to growth. They are aggressively refilling the pipeline, focusing on oncology, vaccines like Abrysvo for RSV, and now the massive obesity market. The problem is that pipeline development is slow and expensive. While Fidelity investments might have the patience to wait 5 years for these bets to pay off, the average Robinhood stock trading account holder, checking their Robinhood app every day, does not. The market is impatient and it's punishing Pfizer for not having a non-COVID blockbuster ready to go right now. For anyone looking at investing sites and considering self-investing in Pfizer, the profile has completely changed. This is no longer the safe haven stock your grandfather owned. This is a high-risk, high-reward turnaround play. You are not buying stability. You are buying a 7% dividend and a call option on management's ability to execute one of the largest corporate transformations in the healthcare sector. You are betting that the Seagen acquisition was brilliant, that the cost-cutting will protect the dividend, and that their new pipeline candidates will eventually fill the massive revenue hole. The risk is that they overpaid, the integration stumbles, the pipeline disappoints, and the company is left with a mountain of debt and a dividend it can no longer afford. Many analysts are on the fence, which is why the consensus rating is a moderate buy. But that rating is skewed by a large number of hold ratings. The bulls see a $140 billion market cap with a 7% dividend, robust cash flow, and a newly acquired best-in-class oncology portfolio, trading at a ridiculously low 13 times earnings. They see this as a once-in-a-decade value opportunity, a chance to get paid handsomely to wait for the turnaround. The bears see a company in secular decline, facing a patent cliff with shrinking revenues and a management team that is spending wildly to chase growth that may never materialize. They see a classic value trap. This stock is not for someone using SoFi Invest for the first time. This is for an investor with a strong stomach and a multi-year time horizon. You won't find this in the same category as Apple stock or Nvidia stock right now. This is in a category all its own. I want to know what you think, because this is one of the most debated stocks on the market. Comment below with your position. Are you holding Pfizer for that massive 7% dividend, or did you sell because you believe it's a value trap? The contrast between the old expectation of Pfizer as a boring, stable, blue-chip stock and the new reality of it being a deeply stressed, high-yield, speculative turnaround story is jarring. The company is doing everything it can, slashing costs, making multi-billion-dollar acquisitions, and protecting its dividend. The market's response, reflected in this $24 stock price, is one of profound doubt. The coming quarters, starting with tomorrow's earnings report, will be critical in showing whether the $43 billion Seagen bet is starting to pay off, or if investors are just getting paid a 7% yield to watch the ship slowly take on water. The reality is that the old Pfizer is gone. The question is whether the new one can be as profitable. Disclaimer: this content is for informational purposes only. Boom! It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. Bang! If you found this helpful, don't forget to like, comment, and share. Like, comment, share. Stay smart with your money. Perfect.